I talked about your report, don't fight the Fed. Certainly that was the right mantra when the central bank was kind of trying to suppress interest rates. But now that we're seeing bond markets are rallying once again, you see the recession risk building.
Yeah.
Is that mantra still sticking, you think?
Yeah, I try not to fight central banks because I end up losing a lot of money. And in my report, I also said, don't fight the Fed and don't fight the tape. And the tape simply meaning market breadth, which is awful. In other words, a lot of stocks are falling and very few stocks are rising, even given the market action last week. So normally when you have both a hostile central bank, or central banks in this case, and a hostile market tape, it's very difficult to make money. Yes, it's true that our global risk love indicator, our sentiment indicator, is in deep panic. And so when you get to these deep panics, even in a bear market, you can get a nice 5–10% rebound, which is, I think, what's happening. Yeah, I still remain cautious and careful. There are obviously pockets which are looking more interesting than they were, let's say, 6 months ago. But our overall message is one of being cautious and being careful, which is the exact opposite of what I was saying from April 2020 to January of this year. At that time, I was unambiguously massively bullish. Now I'm just careful because we need to survive and get to the other side with enough capital in our pockets to play a game.
So how does the second half play out for you then? How durable are the rallies that we're seeing right now?
I don't think they're that durable unless we get this magical decline in inflation and we get really bad data, which essentially changes the mind of the central banks that, well, maybe, or the markets in terms of rate expectations going down. I think that could be that's a low probability outcome. So I think we're in a bad box right now where inflation is sticky, and I think we're reasonably confident that the data flow, the economic data, is going to be quite weak. There's a massive loss of wealth year to date. I think people don't recognize this because it's almost like 60 to 70% of GDP if you combine the losses in bond markets, in crypto, and in equities. And so I think rich people are feeling not as good as they were in January. I think the average person is seeing his or her real wages decline because of inflation. I think there's too much inventory lying around. And I think housing markets are obviously going to slow down. So I think the data flow is going to get pretty bad. And I think the analysts are going to scramble to revise their numbers down.
If China reopens, I guess, is that going to be the standout? And in terms of relative value, can you?
Yeah, if China opens, sure, but that's a very big if. And obviously that's going to be very good for Hong Kong, for China. I think China has become less negative in the sense that policy is easing on the margin. I think they are trying to boost growth, a bit from, I guess, monetary, a bit of fiscal. I think the pressure on the corporate sector is diminishing. And so things are a lot better today than they were, let's say, 6 months ago. And which is why you can see that China is outperforming the U.S. But that's a very rare occurrence.
You mentioned it. It's only about, what, 5%? How often does that actually happen?
So when the U.S. market is falling, which let's assume it is as of now, the last few months, the probability of China actually going up is only 5%. So you've got a 95% chance of not doing well in China when the U.S. is not doing well. Now you can outperform. So the U.S. could be down 10, China could be down 6, so you're still outperforming. But it's really hard, and I think it really boils down to monetary policy. The U.S. is tightening, and China on the margin is easing.
If Asia central banks are not quick to follow the Fed, which they haven't at this point. We're not seeing jumbo-size hikes as of yet, maybe in some other parts of EM, but does the domestic resilience, can that withstand the macro uncertainties right now?
I think it's just really hard. It's like the example I gave for China, that when the US market, when the European markets, when global markets are down, and in Asia we love to use the D word, the decoupling word, and it doesn't work on the way down. In other words, when the US is falling, it's very hard for Asia to do well. There are obviously some exceptional cases like 03 to 07, but it's quite hard.
Do I position then around a recession? Do I position around stagflation? Where are you finding those pockets of opportunity?
I think so. So what we're telling our clients, and we have been really since Jan-Feb, is to not be brave, to be cowardly. There's no need for valor. We just need to survive this battle. And in a bear market, cowards are rewarded and heroes are killed. So you don't want to be an Achilles right now. So the answer to your question is you want to be buying companies that have price and earnings earnings that are not volatile, that don't move with the cycle, that have high dividend yields and high ROEs. And these stocks come, unsurprisingly, from the staples sector, from utilities, and a lot of telecoms, and quite a few financials also.
You mentioned about the high dividend plays as well.
Yeah.
Does that sort of strategy still apply when bond market yields are still, what, talking about the US 2-year, 3-year, above 3%?
Yeah, it still applies. I mean, this is a classic bear market portfolio. So yeah, it does. I mean, obviously you're getting competition from the bond, but if you're an equity player, you need the dividend, which is basically a sign of safety and some income.
Where would you avoid the most at the moment? In terms of where am I going to see most pain in the end?
I feel that the client positioning, investor positioning is very heavy in materials and energy. That's where people have been hiding. And it's worked out reasonably well, especially the energy part. And I feel that, for the well-known reasons of supply side shortages and so on, but I feel that if demand around the world surprises negatively, and these are very pregnant positions for investors, I think you saw a bit of that in the last 2 weeks or so, when some of the cyclical commodity type stories have been going down. So I think that's where the risk really is.